You see gold standing still at the $4,750 mark? Don't let that silence fool you. While you're waiting for a massive breakout, the big players have already completed a silent withdrawal plan without leaving a single trace. Think this is just a normal market consolidation? Think again. Beneath this flat line lies a high-stakes battleground where retail liquidity is being drained. So, who is actually pulling the strings? Today, we decode the invisible hand and the smart money traps hidden right in front of your eyes. To understand why your wallet is under threat, you need to look at what regular candlestick charts are hiding from you. On the surface, gold trading between $4,720 and $4,750 looks boring. It looks like a market that has simply run out of steam. But if you look at the volume data, something doesn't add up. Retail sentiment is at a fever pitch. Normally, this level of buying pressure should launch the price into the stratosphere. Yet the price remains pinned, almost unnaturally, within this narrow corridor. Why? Welcome to the value area. In professional trading, the value area is where 70% of the day's volume occurs. It is the fair price agreed upon by big institutions. While retail traders see a flat line as a lack of movement, smart money sees it as a high-efficiency zone to fill massive orders. Imagine trying to fill a swimming pool with a garden hose. It's easy. But if you're a central bank trying to fill that pool with a massive industrial pipe, you have to do it slowly, or you'll cause a flood, or in this case, a price spike that makes your own entry too expensive. This is where the Iceberg order comes in. An Iceberg order is a large single order that has been divided into smaller limit orders, usually by using an automated program, for the purpose of hiding the actual order quantity. Just like a real iceberg, you only see the small tip, perhaps 100-ounce buy order on your screen, but beneath the surface, there's a 10,000-ounce order waiting to be triggered. Every time the price tries to dip below $4,720, the tip is replenished. Every time it nears $4,750, a massive sell wall appears out of nowhere. Smart money uses these algorithms to keep the price stable, effectively locking the market in place. They aren't just waiting for news, they are actively manufacturing this stability to ensure they get every single ounce they want at the best possible price. But here is the logic you must grasp. When an institution spends days or weeks building a position using iceberg orders in a specific value area, they aren't doing it to make a 1% profit. They are preparing for a trend shift that will move the needle by hundreds of dollars. The longer the price stays flat, the more massive the hidden position becomes. Think about it. If the world's most powerful financial entities are using sophisticated AI and billions of dollars to hold a price level, they know something you don't. They are waiting for the liquidity exit, a moment where they can flip the switch and let the price run. But are they loading up their magazines to shoot the price to $5,000? Or are they quietly offloading their bags to unsuspecting retail buyers before a correction? This is the million-dollar question. To find the answer, we have to look past the how and start looking at the who. Is this a massive accumulation phase by the East or a distribution trap set by the West? The clues are hidden in the recent data from the World Gold Council, and what they reveal about the sharks of the East might catch you completely off guard. But here's the twist. Not all sharks swim in the same direction. To understand why gold is stuck in this $4,750 tug-of-war, we have to look at the latest data from the World Gold Council. The report is clear. Central banks, led by the BRICS Plus nations, are buying gold at a record-breaking pace. For them, gold isn't just a trade, it's a strategic shield against a volatile US dollar. They are in the accumulation phase, patiently building a floor under the price, ensuring it doesn't collapse. This is why every time gold dips toward $4,700, a hidden hand scoops it back up. It's institutional-grade diamond hands. But be very careful. Just because the Big East is buying doesn't mean the Big West isn't selling. While central banks are accumulating for the long haul, high-frequency hedge funds and Wall Street desks might be doing the exact opposite. This is the classic battle between accumulation and distribution.
Think of it like this. If central banks are the foundation of a house, hedge funds are the furniture. The foundation is solid, but the furniture can be thrown out of the window at a moment's notice. While the BRICS Plus nations buy to hold for decades, Western funds are looking at the yield curves and the surging DXY. To them, gold at $4,750 is a price of exhaustion. They might be using this sideways crawl to quietly offload their bags to retail buyers who are blinded by the gold to $5,000 headlines. This is the ultimate deception of the market. On your screen, the price looks stable, but behind the scenes, a massive transfer of wealth is happening. The central banks are absorbing the supply while the speculative funds are providing it. So how do you tell the difference? How do you know if this sideways movement is a launch pad or a trapdoor? In a true accumulation phase, the price holds steady despite bad news. The sharks are hungry and they eat every sell order that comes their way. But in a distribution phase, the price stays flat even when the news is good. It's like a ceiling made of lead. No matter how hard the market jumps, it can't break through because the big funds are hitting the sell button every time the price ticks up $1. Right now, we are seeing a clash of the titans. One side is building a fortress while the other is setting a trap. If you're a retail trader caught in the middle, you're essentially dancing on a landmine. If the central banks stop buying for even a week, the floor vanishes. If the hedge funds stop selling, the ceiling shatters. But there is a specific technical phenomenon happening right now that reveals exactly which side is winning. It's a move designed to wipe out the weak hands before the real trend begins. It's a tactic known as the liquidity trap. And if you have a stop-loss order sitting anywhere near $4,700, you are the primary target. Let's look at how they plan to hunt your liquidity before the price is allowed to move an inch. Because right now, the zone between $4,720 and $4,750 isn't just a consolidation range, it is a carefully constructed liquidity trap. If you are a retail investor using leverage or tight stop losses, you are the primary target of this maneuver. Why? Because market makers and big institutions need liquidity to execute their massive trades without slipping the price too far. And where is the most liquidity found? It's sitting right behind those obvious support and resistance levels. Imagine you've set a buy order just above $4,750, thinking, if it breaks this, it's going to the moon. Or perhaps you've placed a stop loss just below $4,720 to protect your capital. You're on alone. Millions have done the exact same thing. This creates a massive pool of orders that the smart money sees as a delicious meal. This is where the fake out, or what we call a stop run, comes into play. You've seen it happen 1,000 times. The price suddenly spikes above $4,750. The charts look bullish. The breakout is here. You jump in, fearing you'll miss the boat. But minutes later, the price reverses violently, crashing back into the range. What just happened? That wasn't a breakout. That was a liquidity grab. The institutions pushed the price up just enough to trigger your buying orders, using your buying power to fill their massive sell orders. They sold to you at the highest possible price, then pulled the rug. The same thing happens on the downside. A sudden sharp drop below $4,720 scares everyone into selling or triggers every stop loss in sight. The moment the weak hands are forced out of their positions, the price miraculously bounces back. In the industry, we call this hunting for liquidity. The danger of this $30 range is that it is narrow enough to keep you frustrated, yet wide enough to make you feel like you can scalp small profits. It is designed to induce over-trading. Every time you enter and exit, you are paying fees and providing the very liquidity the sharks need to build their positions. The smart money knows that human psychology is predictable. We hate uncertainty. We crave movement. By keeping the price in this dead zone, they're effectively shaking the tree. They're waiting for the moment when the market is balanced, meaning they have successfully cleared out the retail traders who would get in the way of the real move. Think of this range as a pressure cooker. The longer the price stays between $4,720 and $4,750, the more energy is being stored. But that energy isn't just technical, it's financial. It's the collective capital of thousands of traders who are being trapped in a losing cycle. So how do you avoid becoming the exit liquidity for a billionaire's hedge fund? It starts by changing how you look at these levels. Instead of seeing $4,750 as a signal to buy, start seeing it as a zone of maximum danger.
But there's one more layer to this mystery. This trap isn't happening in a vacuum. While the charts are being manipulated, something much bigger is shifting in the background. A global economic clock sync involving the US dollar and geopolitical tension that hasn't been seen in decades. If we want to know when the trap will finally spring, we have to look at the trigger, the US dollar index and the high-stakes game of geopolitical chess. If we want to know when the trap will finally spring, we have to look at the hidden trigger, the US dollar index and the high-stakes game of geopolitical chess. Because in 2026, gold doesn't move in a vacuum. It moves as the inverse shadow of the greenback. Have you noticed the DXY recently? While gold is hovering in its $4,720 to $4,750 cage, the US dollar index is performing a delicate tightrope walk. We are in a period of forced stability. The Federal Reserve has hit a temporary pause on its quantitative tightening, waiting for the latest inflation print. This has created a vacuum, a buffer zone where neither the dollar nor gold wants to make the first move. But smart money isn't just watching inflation, they're watching the friction points of the globe. The reason the $4,750 level is being held so fiercely is that we are currently in the eye of the storm. Geopolitically, 2026 has been a year of massive shifts. We've seen the deepening of the BRICS Plus payment systems and a subtle but steady move toward de-dollarization in global energy trades. For the big players, gold isn't just a commodity right now, it's a political insurance policy. Why go sideways? Because the institutions are waiting for a geopolitical catalyst. It could be the outcome of the latest Beijing-Washington trade summit or a sudden escalation in the Middle East energy corridors. When these events hit the headlines, the liquidity trap we discussed earlier will snap shut instantly. Think of the $4,720 to $4,750 range as a neutral ground, a no man's land. The smart money has already built their positions. They are now sitting on their hands waiting for the dollar to show its weakness or for a geopolitical event to trigger a flight to safety. If the DXY breaks its support level, the lead ceiling at $4,750 will vanish and the compressed spring will launch gold into a territory we've never seen before. However, there is another possibility. What if this sideways movement is actually a safe haven for capital that is fleeing from crashing bond markets? If that's the case, the stability isn't a sign of strength, but a sign of a waiting room. Institutional investors are parking their billions in gold because they don't trust any other asset class right now. They aren't buying because they want to, they are buying because they have to. This creates a volatility coil. The longer the world remains in this tense, uncertain geopolitical standoff, the more violent the eventual breakout will be. We aren't just looking at a price chart, we're looking at a thermometer for global stability. And right now, the temperature is rising, even if the price is standing still. The big question isn't if gold will move, but who will be left standing when the dust settles. Are you prepared for the moment the dollar loses its grip and the silent accumulation turns into a global scrabble for the exits? As we wrap up this deep dive, you have to ask yourself one final question. Are you positioned to ride the wave, or are you about to get swept away by it? As we've uncovered today, the sideways crawl of gold between $4,720 and $4,750 is anything but a period of rest. It is a calculated, high-stakes game of financial chess. What looks like dead air on a chart is actually the sound of billions of dollars shifting hands in the dark. We're witnessing a massive transfer of wealth. While the smart money uses algorithms and iceberg orders to keep the price pinned, they are preparing for a global economic realignment. The compressed spring of 2026 is getting tighter by the day. Whether it's the strategic accumulation by central banks or the cold, calculated distribution by hedge funds, one thing is certain: the breakout will be violent and it will be sudden. The question isn't no longer about where the price is going, but where you are standing when the trap finally snaps shut. Now, take a long, hard look at your portfolio. Are you positioned alongside the central banks, building a fortress for the future? Or are you simply acting as exit liquidity, the fuel that the big funds need to escape before the next crash? In this market, if you don't know who the liquid is, it's probably you. So I want to hear your strategy. At what specific price point are you planning to make your move? Are you holding for the $5,000 moonshot, or is your finger already on the sell button? Drop your target price in the comments below and let's dissect the crowd's next move together. Don't just watch the market, understand the hand that moves it. I'll see you in the next deep dive.